Good morning. My name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. The holidays are finally here, a time of giving goodwill to others and embracing traditions. For many people, giving to a charity or organization that aligns with your values provides a sense of fulfillment. If you itemize deductions on your income tax return, you can deduct gifts made to charity. Here are 6 year-end giving strategies to spread holiday cheer with the additional gift of potential tax benefits. Number 1 is making cash gifts. If you give cash, you may deduct up to 60% of your adjusted gross income, AGI. Giving cash also provides a charity better flexibility when it comes to spending the money to help the people, animals, or the environment. 2 disadvantages of giving a cash gift are liquidating a stock, bond, or other appreciated asset and being responsible for the generated capital gains tax, and you also don't always know how the money is necessarily being used. Number 2, donating stocks, bonds, or other appreciated securities. If you're considering donating the earnings from appreciated stocks, bonds, real estate, or other appreciated non-cash assets directly to your charity of choice, you may want to think about giving the appreciated asset directly to the charity over giving cash after selling them. This may be a beneficial strategy as it allows you to avoid the capital gains tax so long as you adhere to the rules. In addition, you would be eligible for a charitable income tax deduction up to the fair market value of the security you donate, up to 30% of your AGI. A financial professional can help you with the nuances of this type of giving strategy. Number 3 is Donor Advised Fund, also known as a DAF. A DAF is a fund managed by a third party that handles charitable donations given to a specific charity. Donors become eligible for an immediate tax deduction in that calendar year. They can give anonymously, knowing that the money can grow tax-free and may be able to bypass capital gains taxes. There are various ways to give, including cash, stocks, bonds, and other appreciated stocks. There are a couple of things to consider when deciding on a DAF. Initially, there may be high startup costs. Funds are not eligible for donor benefits, for example, scholarships and tickets, and there is limited control regarding grant making. Being a DAF donor also gives you the authority to recommend grants from the fund to charitable organizations you support over time. Number 4, bunch your charitable gifts. Bunching your charitable donations is a tax strategy where you take and make a multiple year contribution in a single year to maximize your itemized deduction for the year in which you make your donation. The strategy is to make your itemized deductions, including charitable deductions, large enough to exceed the standard deduction amount. Bunching charitable gifts involves timing and the amount you plan to give. This has become a popular strategy after the Tax Cuts and Jobs Act of 2017 that nearly doubled the standard deduction through 2025. You have to remember that your donations must be to a qualifying charitable organization, generally nonprofits with tax-exempt status under Section 501c3 of the IRS Code. Number 5, contribute restricted stock. If you contribute directly to a public charity, including sponsors of donors advised funds, the donor can qualify for the income tax deduction for the full market value, FMV, of the securities in an amount up to 30% of the donor's adjusted gross income, with a 5-year carry forward of any excess not deductible in the year of the contribution. When giving stocks as opposed to the after-tax proceeds from selling the stock, the charity receives the full market value of the appreciated stock, and the donor is not subject to capital gains tax on the appreciation in the stock. 6, combine tax loss harvesting with a cash gift. Tax loss harvesting involves using capital losses to offset capital gains up to $3,000 of ordinary taxable income. Donors who itemize the deductions can then claim a charitable deduction for donating cash from the sale proceeds. But to use this method, you have to understand when to apply it. Tax loss harvesting only works on taxable investments. Several retirement accounts, for example, IRAs and 401ks, are tax deferred and therefore are not eligible to be used to offset taxable gains. Also, if you're somebody that just invests in mutual funds or exchange traded funds, ETFs, tax loss harvesting may be more difficult because to use tax loss harvesting, the whole fund has to be down, therefore limiting its tax saving capabilities. And finally, remember that charitable giving and potential tax benefits are often complex, and decisions not carefully weighed could impact you and your financial goals. Consider consulting a financial professional before making any financial decisions that could put a damper on your holiday cheer this year. Happy holidays. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon, and don't forget to also subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.